Hi, welcome to Chapter 2, Part 1 of Business Law and Ethics. This is forms of carrying business or carrying on business. The objectives for you to learn in this chapter is sole proprietorship, describe partnership, explain how a partnership can be created, review the rights and duties of partners, discuss the liabilities that may incur by partners, list the advantages of a partnership, and explain how a partnership can be dissolved. So let's take a look at types of business organization here in Canada. First one is sole proprietorship, an individual carrying on business alone. Partnership, general limited, and LLP, two or more people carrying on business together for the purpose of making a profit. And corporation, a legal entity separate from the people who own and control it. So let's look at them a little closer. Sole proprietorship, an individual carrying on business alone. Here they must follow the licensing and governing laws, which have to do with registration and licensing. Zoning, bylaws in different parts of the city and neighborhoods will vary. Comply with workers' compensation, employment insurance, and income tax regulations. Keep sufficient records to satisfy government agencies. And this is unlimited liability for financial obligations and vicarious liability for torts of employees. So this unlimited liability can be the most significant disadvantage of the sole proprietorship. When liability is incurred for breached contract or torts, or where there is insurmountable debt, the whole burden falls on the sole proprietorship. There's no differentiation. So we look at vicarious liability, same thing. Situation in which one party is held partly responsible for the unlawful actions of a third party. Under the principle of vicarious liability, the sole proprietor is responsible for any tort committed by an employee during the course of employment. And I'm not sure if this was defined in the past, but just let's redefine it. A tort is a wrongful act or an infringement of a right other than under contract leading to civil legal liability. Let's look at partnership. A group of people carrying on business together with the object of making a profit, not a separate legal entity. But here, the partnership can enter into legal relationships so that it is not necessary to contract with each partner individually. There is a Partnership Act, and this goes way back to the United Kingdom, adopted in all common law provinces and still present with a few alterations or changes. A partnership is not always created by formal agreement between the partners, and this act provides that a partnership is created when two or more people carry on business in common with a view toward profits. The act also requires that the parties carry on continuing business together. Okay. So partnerships created by inadvertence. Partnerships can be created inadvertently. A partnership is presumed joint contribution of capital to establish a business, intention to share expenses, profits, or losses, joint participation in the management of a business, and partnership must carry on continuing business. So partnership created by contract, here best to create a partnership is through a contract, so everything is written down. Written contract is not always conclusive proof as to the existence of a partnership, but certainly is proof. Statutory rights and obligations of the partners can be modified by agreement. So partnerships by agreement or partnership agreement should deal with duties of each partner and what type of work or talent each is expected to contribute and do, amount of time and money to be committed to the business by each partner, and how the profits are to be shared and how the capital is to be distributed. So every information, as much information as possible, goes into this contract of agreement. Any limitations on the powers or authority of each partner. Also, methods of resolving any disputes between the partners and how the business is to be managed. The circumstances in which the partners will be dissolved. This is created by contract. Unlimited liability is not limited to the assets of the partnerships. So personal assets may be used to satisfy claims against partnerships. That means your house, your car, your finances. Insurance coverage is important. Disadvantages may be reduced by insurance. So a third party can collect from any partner, and retiring partners remain responsible for existing liabilities. So partnerships is a little bit more adventurous, let's say, than sole proprietor. So requirements of unanimous consent protects partners, less expensive to form and operate than incorporations, and there is also some tax advantages available here. This is why you hear this, the definition of a silent partner. So limited partnerships are liable only to the extent of their investment, avoids the unlimited liability that goes with being a general partner, provides some of the advantages of incorporation to partnerships, and limited partners cannot take part in control of the business. So registration here is required for a limited partner. So if we look at LLP, limited liability partnerships, this dates back to Ontario 1998, and eligible professionals, accountants, lawyers, and dentists. So the victim cannot pursue individual assets of a non-negligent partners. Now, just to say that LLPs are certainly a flexible legal and tax entity that allows partners to benefit from the economies of scale by working together while also reducing their liability for the actions of the other partners. So as with any entity, legal entity, it is really important that they check the laws in the land before getting too excited. So in short, check with the lawyers first. The chances are good that they have first-hand experience with an LLP, right? To understand more about it, it's best to start with a general partnership. So general partnership, again, is a for-profit entity that is created by a mutual understanding between two or more parties. So LLPs allow for a partnership structure where each partner's liabilities is limited to the amount they put into the business. And LLPs are common in professional businesses, like as we see here, like law firms, accounting firms, and wealth managers. So dissolution of a partnership, here notice of intention to dissolve can bring partnerships to an end. The death or bankruptcy or insolvency of a partner also ends right there and then. Fixed term expiry of partnerships could also be in part of dissolution, and a partnership can be dissolved by request to the court. So there's many ways a partnership can be dissolved. And let's take a look at payment of debts and liabilities, profits, capital, and personal assets of partners. This is subject to the partnership agreement. When dissolving a partnership, the debts must be paid first out of profits. And if they are insufficient, out of capital the partners originally invested. If there's still not enough money to pay the debts, the creditors can then turn to the partners themselves, who are liable in the proportion in which they are entitled to share profits. So now remember that all partners are liable to pay the creditors no matter what the partnership agreement says. Again, this is part one, so we will stop here. Distribution of assets after payment of debts. So now once all creditors have been paid and the other obligations of the partnership are satisfied, any assets still remaining are applied first to pay back the partners for advances and then to pay back the original capital investment. So any remaining funds are divided among the partners on the established basis for sharing profits. So we will stop here in part 1 and we will continue part 2 next time.